So I appreciate everyone for being here today. Michelle, I know you're going to be telling everyone about yourself, but I've used the 1031 exchange method for when I was leaving my starts in real estate investing from California to Florida, and it was very advantageous, and continue to use it on certain properties of selling into something else. And I think there's a lot of rumors and misconceptions, and also even like doubts and fears of 1031s. And I know you're going to be able to relieve that today. So I'm going to be here, but I'd love for you just to introduce yourself and let's go through, because this is one of the most important conversations I think we can have. And I know we always joke, and we were joking before we started, oh, no one wants to listen to taxes for a half an hour.
Right.
But when you understand the 1031 and the way this tax deferment works, it can create millions of dollars of profits for the astute investor. So, Michelle, thank you for being here. Please tell us about yourself, and we're here to listen.
Absolutely. Thanks so much, Jim. I appreciate it. And yeah, my name is Michelle Goheen, and I am a CPA. And as a CPA, before I was really familiar with 1031 exchanges, I was kind of afraid of it too. It sounded very complex, very complicated. And many years ago when I got into real estate and started digging into 1031s, I realized it really is not that complicated if you just understand the rules. And so what I wanted to do today was just kind of go through what is a 1031, show you why it's so beneficial for real estate investors, how you can really leverage that to scale your portfolio, and like we say on here, simplify your life. So, and this all happens on a deferred tax basis, which is really fun. So we will just kind of go in. It's a really good fall, so that's kind of fun. And I have a number of student housing projects, like I mentioned, at Ole Miss, and we kind of we call it the Hunger Games when it comes to housing there, just because it is so crazy, and everything is 100% leased through July of 2026. But most importantly, today, for what we're talking about, I'm the co-founder of the Real Estate Tax Strategy Institute. And we really love to help people, as yourselves, really understand the benefits of these types of tax strategies and how you can use them. And you don't need to know all the details, because you just need to know the people who know all the details. And we'll kind of talk through some of that there. But you just need to know what you need to do when you identify some appreciated property that you have that you're interested in selling. And we'll explain to you why this will be a great benefit for you. So we'll start off. What is a 1031 exchange? You probably have heard that all over, oh, I'm going to do a 1031. So what this essentially does is it allows you to take appreciated property that you have. It has to be investment property. It can't be a home that you actually own as a residence. And then it allows you to invest those funds when you sell them into other properties, and it allows you to defer the capital gains. And we'll walk through an example here in a second and show you exactly how that works. So you're not avoiding taxes forever, you're deferring them, but you will be able to roll those into a new deal. What it allows you to do really is to unlock trapped equity that you have in these properties, and you can reinvest that into cash flowing properties and generate passive income that can be largely offset, if not fully sheltered, by tax deductions. And we can talk about that as well. So every time you don't do a 1031, you're essentially giving 25, 30, 35, it just depends what state you're in, a large portion of your profits to the IRS. What we'll be able to do is show you how to take that and be able to keep all of that. And one of the things that's interesting, there's a ultimate deferral strategy. They call it swap till you drop. So essentially, if you keep doing 1031s, essentially, there's only two things that are guaranteed are death and taxes. So we're going to avoid the taxes until death. So if you just keep swapping them until you die, your heirs will get everything at the stepped up value, which means if you have a $200,000 property now that we're going to sell for $1 million later in this example, if you keep doing this, if you sold that to your children or gave it to your children right now, they would have to recognize that gain eventually. But if you just allow it to pass on after your death, they will get that property at that stepped up value or that appreciated value at no taxes. So that's kind of the ultimate strategy here. So um, One of the other benefits that using a 1031 allows you to do is to sell a property that may be a little work right now. A lot of people do 1031s where they've had short-term rentals that are older and have caused a lot of maintenance issues, or they have to maybe it's a short-term rental, and we all know how difficult short-term rentals are, or they have land that maybe has been held for investment but has not really been utilized. You're able to take this dormant or actively managed investment property and you can reinvest it into anything that's as long as it is an investment property. So it allows you to also shift your from being an active landlord to being where you have passive income. So it can really kind of upgrade your life where you're no longer uh, actively we like to say it's you're in real estate but not in real estate, so you don't actually have to do all the hard work. So we're going to show you here how you can upgrade to professionally managed real estate. You can unlock diversification and improve your cash flow. All of that's great stuff, right, Jim?
Absolutely. All the things.
Absolutely. So here, let's use this example that I mentioned earlier. So let's say somebody has a property that they paid $200,000 for years ago. And so over the years, you have put $100,000 into it. And then you also have $100,000 of debt. That's just kind of an important nuance that we'll talk about here in a little bit. You've been doing it just as, let's assume, just a straight line depreciation over the years, and you've taken some depreciation, and now your basis is just under $200,000. So if you go and you have a sale and you're going to be selling it for $1 million, your capital gain, I don't know if you guys can see my uh, pointer right here, is going to be $800,000. So if you don't do a 1031, look at what your taxes are going to be. You are going to owe, and we just use a state tax of 5%. If you're in California or some of these other states, you know your taxes are going to be a lot higher than that. So you would literally get $773,000 after taxes. And that's kind of a bummer because you're losing $226,000 you could be actively reinvesting if
Yep.
you just knew how to do a 1031. So if you do a 1031 in the same example, you will owe $0 in taxes. And it's totally legal. This is a section 1031 of the tax code that we're talking about. You just have to understand what the rules are and follow them. So the IRS says you must swap into like kind property. And when they say that, they don't say, oh, you have a single family rental, you need to switch into another single family rental. It's nothing like that. It's like kind property where it's also investment real estate. So you'll see on this side what qualifies. And this is just a short list of these types of things, but it has to be an investment type property. Single family rentals, duplexes, commercial buildings, raw land that you have held for investment, new construction, long as it has been held for investment. But what doesn't qualify is, like we mentioned, your primary house, or if you have a second home that you've used significantly for personal use. If it is an Airbnb, again, you'll want to really talk with a tax advisor as to how you have documented your personal use on that, just so you are sure that this does qualify for like kind property for the exchange. And so that's something that we can help you with and go through and just make sure that you have all of those I's dotted and T's crossed, because you would hate to get this done and then realize that your property really did not qualify. So the key takeaway, if it's a property that's held for investment, it likely qualifies both as your sale property and your replacement property. So just when you hear like kind, don't think, oh gosh, I'm already in a high maintenance single family rental. Um, you don't have to go into exactly that. You can do other things as well. So, um,
Can I ask a quick question, Michelle? When you
absolutely.
say short-term flips, that's anything that's bought and fixed up and held for under 12 months. Would that be correct?
That's correct. Oh, I think I skipped over that piece of the slide. Yes, exactly. So anything that you've had for less than 12 months that you are looking to flip, generally that is going to be disqualified under a 1031 exchange. So they do want you to hold it have something that you've held for investment, meaning more of a under leases versus just a purely flip type of situation.
Mhm. Got it. Okay, thank you.
So, um, okay, so what I'm going to show you here is this is just the example of what this could look like. If you have a 1031 and you have $1 million from our example that you're going to come in, you could come in and buy a new quadplex. Uh, I know the Southern Impression Homes has some really cool fourplexes that are available right now. I went and looked on the website and did some shopping myself. So there is a quadplex for this price right here. So we could literally take our single family home that we have sold now and turn it into a fourplex by doing this type of exchange. And so what you're going to want to do is you'll have the equity from your sale. Now, one of the things that they do talk about is that you will need to have replacement property, or I'm sorry, replacement debt if you had existing debt. So, like we mentioned on that first property that we were exchanging, we had a $100,000 mortgage. In order for the 1031 to be affected, you have to have the same amount or more debt on your 1031. Does that make sense?
It does.
So,
And
yeah.
Michelle, just for clarity, that could be you could buy two properties and $50,000 on one and 50,000 on the other. As
Mhm.
long as you are fulfilling that same equal amount of mortgage debt, it's fulfilled.
Yes,
Correct? Okay.
exactly. Okay. So, what counts as like kind property? When you hear about 1031s, you'll often hear it has to be like kind. And what that does not mean is if you have a high maintenance single family property that you want to sell, you do not have to buy one that is like kind. You just have to buy something that is investment real estate. So on the side here, it does show the different types of things that do qualify as like kind property. As long as it is an investment in real estate, it essentially does qualify. One of the things that we'll talk about is raw land, for an example. People will have hunting leases and things like that. So there's a lot of ways that you can use this as like kind property, but the intent has to be that is investment real estate. So we'll talk about it a little bit later as to just some ideas on what you can do to make sure that you are meeting that criteria for the like kind. Also, similarly with second homes that are used as Airbnbs, you will want to make sure that you have not disqualified your property as being a personal property use if you don't have your personal days or your material participation for your short-term rental documented appropriately. So those are the things that we can help you with at the Tax Institute is to make sure that you have properly documented what your like kind investment property is that you're looking to put into your 1031. So again, just because it says like kind doesn't mean you're stuck with exactly what you have. You can trade an office building for new construction. You can use an Airbnb to buy some quadplexes that are new construction. There's all sorts of permutations of what you can do. I will mention that there's a couple of restrictions when it comes to short-term holdings and properties that you're buying purely to flip, that these generally do not qualify as like kind and are not eligible for 1031 exchanges. So generally, if you've bought a piece of property, you're going to fix it up and sell it. Generally, that is not included in the 1031s. So let's go through this example right here. So earlier we talked about we had $1 million to spend from our 1031. Uh, and generally, what it does is your sale price, your $1 million, is what you have to reinvest in another property. Not your gain, not your basis. It's actually the sales price. So the $1 million. So what we're going to do is show you two different examples of how this could work. First of all, is we're just going to spend our $1 million that we have. I went onto the Southern Impression Homes website and found this really cool quadplex that I personally would buy. And so here's the cost of the quadplex. There's some closing costs, and there's certain closing costs that you can include uh, in your expenses to get to your $1 million. So here we go. We've spent $1 million. Now, if you'll remember, I mentioned that there was a requirement for debt. If you had debt on your existing property, you put debt on this property as well. So I think my slide's a little off right here, the 60% LTV. So let's ignore that part. But we're going to have $900,000 of equity from our exchange, and then we'll have $100,000 of equity that we brought in. Now, this is going to replace your debt and also cover the amount of equity that you have that you've brought over. So essentially, what you have at the end of the day is you have $1 million. You have no taxable boot. What boot is if you've taken any cash out that ends up taxable. We'll talk about that in a little bit. So you'll have a full 1031 deferral achieved, and you'll have 4 rental units, which I think is so cool. You go from one probably high maintenance property to 4 rental units. So you'll be able to really elevate your cash flow in this example. But let's say you really understand the power of passive real estate, and you want to kind of grow beyond just your fourplex or your $1 million. So the 1031 doesn't say that you are limited at $1 million. You can also go in and spend more money. So I went in and found 2 quadplexes that I liked and another single family house. So Jim, I'm doing a lot of shopping today. Uh, so what we did, we ended up outlaying $2.3 million. But let me show you the power of this. So you're able to bring over your equity from the 1031, which is the $900,000. And then we're able to take out some mortgages on these new properties. And what's cool is the interest from your mortgages is going to be tax deductible as well to offset the income that you've brought in. So this is going to replace your $100,000 of your debt, and it's going to use some leverage to scale your portfolio. So what you've ended up doing here is you have $2.3 million worth of property. You have no taxable boot from the 1031. You've fully deferred your gain, and now you have 9 rental units. So I think that shows that you can invest just your $1 million, or you can also invest more equity or more debt. So you're not limited to just that amount. So any questions?
No, I think that's, pretty powerful to show how it can be leveraged into multiple directions, depending on your risk tolerance, how big you're wanting to grow. But it can be utilized in multiple ways. And that's a great.
Absolutely. Absolutely. So you're not just one for one, you can be one to many as well. So we'll kind of show that here in a minute. So we kind of showed you what the power of 1031 is, but let's kind of go through what these rules are, because it's not that complicated. You just really need to understand what the rules are and how you need to prepare for that when you start looking at your portfolio. So one of the biggest things, and the reason that most 1031s end up getting disqualified, is that as a seller, you can never take possession of the sales funds. So when you go and you go to your title company, they can never send you the money. All the funds need to go to what's called a qualified intermediary, which is not you, and it's not your attorney, it's not the title company, it's not your bank. You can take out a portion of it. So in our $1 million example, if you needed to take out $100,000 to pay some expenses or to use as you'd like, you can take that portion out, but that is going to be taxable at your current rate. So that's called boot that we talked about. So what you must do is have a qualified intermediary, and this person holds your funds, then they document everything for you so that you are ensured that you have the full compliance with the IRS. So qualified intermediaries, I know several really great ones. I give you my email at the end. Feel free to just reach out. I'm glad to make those introductions to you. Now, the other thing that's really important is that timing is very important. So from the day you close, there's 2 timetables we're going to talk about. The first one is you have 45 days to identify what your replacement property is going to be. And then you have an additional 135 days to actually complete the purchase. So it's 180 days total. So, and then we talked about they must be reinvested in like-kind property. So let's dive in a little bit more into the timing. Okay, again, make sure you get in touch with a qualified intermediary, and then having a general idea about what you want to buy when when you're approaching the close. So with this 45-day rule, you must have a list that you submit to your qualified intermediary that was in 45 days of what you want to buy. And so you can identify up to 3 properties with no limit on value, or any number of properties that you want to buy, as long as your total value doesn't exceed the 200,000 or 200% of the property that you sold. So what we're saying there is you can go in and maybe you're not exactly sure what you want to buy, but you know you want this, or this. And so as long as the properties that you end up buying are on this list, then you're good. And there is a phrase in here that's called unambiguous. I can't even say this word. Unambiguously described. So essentially, you can't just say, "I'm going to buy some homes from Jim." You say, "I'm going to buy 123 Main Street, this city, this state, zip code." You have to give either a street address or legal property description in your properties that you identify. So I looked on the website, and Jim, I know you have a whole portfolio of things that basically at any time people would be able to go in and
Yeah.
find things that they could close on within a quick period of time.
Yeah, we're very 1031 exchange friendly now. A few years ago, before we were on this continual build cycle, and now we release homes at CO, we were selling pre-construction, and we couldn't do 1031 exchanges, which was really
Mm.
something we wished we could. But now we're very excited because a lot of our people are 1031 exchange buyers that are coming to us now, and our properties have no problems hitting the deadlines.
Right. I mean, it makes so much sense. Especially, I love how you manage it and just do the whole process for people. And that's going to be such a relief after they come from doing a lot of this probably themselves
Yeah.
and are just tired of being in real estate.
Yes.
And so one thing I do want to mention, you're identifying your replacement property, there are very, very strict rules about it cannot be from a related party. And that means your parents, your kids, your grandparents. There's a whole list of, you cannot go and buy property from them. So again, make sure that you read up and are firm on these rules if you were looking to do something like that. So, and again, just make sure that everything is closed within 180 days, and the countdown starts the day that you close on your original property. So, and again, there's a number of closing costs that you can include in your price, that can be covered with the 1031 funds. So, a list of those on the side. And then there's also a number of things that cannot be included. And these are generally things that are recurring in nature, your HOA dues, your prepaids, and any type of allowance that you might have put in there for repairs. So those are not able to be 1031 exchanged. Okay, so these are just some ideas. I was kind of thinking through, what have I seen lately that really makes a lot of sense. These are examples that allow people to improve their income, that can step away from being hands-on, can scale their portfolio, and really have some greater tax efficiency. So there's a couple of ideas. I had somebody had a beach house, a very nice, expensive beach house, and they went from one beach house to 10 long-term rentals. And the thing that was fun about that, they joked, they're like, "Nobody calls us at 2 a.m. now to check in." And they were like super excited about that. In that, yeah, I'm sure you probably hear that all the time too.
Yes.
Um, we had somebody else that bought a duplex and then, or I'm sorry, sold a duplex that they had. Again, it was older, it had a lot of maintenance. They bought a quadplex and they wanted to diversify a little bit. And so they also invested $100,000 in a syndication through a tenancy in common. That's something that I do through um, my private equity fund. And we really have been able to take in a lot of 1031 funds that way as well. So people are looking to do multiple things with their 1031. That's also an option. So that pairs just rental income with some cash flowing investments all in one exchange. Um, Probably my favorite thing that people do with 1031s is they do take these older appreciated rentals that are worth quite a bit, but they're in markets where they're not able to get really the rents that $1 million home would probably, it would sound like it would be able to achieve. And these are properties that, they've had for a while or they've inherited, and there's just a lot of maintenance in them. You never know what's going to break. Uh, they sell those and they buy new construction.
Yeah.
I'm all about new construction. I know you are too,
Yeah.
Jim.
We see that a lot now.
A lot. I mean, how great is that? You get much more income. Your repair and maintenance costs are so much less. You're not going to be worrying about, what's going to break next. That's just not a fun thing to have to worry about.
Yeah.
And so let's start over. One of the things I wanted to talk about is my land that I have eligible for 1031. We see a lot of people or talk to a lot of people, especially I'm in Texas, who have hunting leases or big pieces of land out in the country that they've used for different purposes, whether it's a farm or is it a hunting lease or is it ranch land, whatever it may be. And there definitely is criteria to make sure that your property is identified as investment use property. So the ownership and the holding intent is really important. If it's a piece of land that you and your buddies go and hunt on, every weekend during hunting season, that's going to be difficult to have as be considered investment property. Now, if you want to, let's look at it, and there's things that you can do to actually paper this. You probably can't go hunting for a while, but if you want it to truly be a 1031 exchange property, there's some things that you can do where you can put leases in place. Not have you don't use it as personal use. So there's some things like you'll talk about on here. They're treated as investment costs. Maybe you need to put a billboard on it or some animals to graze. There's things that you can do that show that your property is truly being held for investment purposes. And you as the owner are going for business oversight as opposed to just going and spending your weekends there and posting it all over Facebook or Instagram. So, anyway, those are things that are really important that you can do to make sure that these properties that you have right now will be eligible for a 1031 exchange.
Perfect.
So, I get that question a lot, which is why I wanted to go
Sure.
ahead and throw
I'm
this
sure.
slide in. Okay. And then there's also how long do I have to hold a property before doing a 1031? And this is one of those kind of ambiguous areas that there's nothing really in the tax code that says you must hold it this long. However, if you like to read tax law and court cases, like I kind of like to nerd out on, these court cases would suggest that you should generally hold your property for 12 to 24 months as an investment, as not and not for personal use. Like we talked about, maybe converting your lease or your hunting property over to actual investment real estate for 12 or 24 months. You treat it as a rental or a business property on your tax return, which means you're going to report it on generally on a Schedule E, which for your tax purposes, and then avoid flipping because quick resales do raise red flags and can disqualify your exchange. So what we've had here is best practices. You're going to hold the property for at least a year, rent it out, clearly document your investment intent. You're going to have lease agreements, you're going to have ads, you're going to take depreciation, all of these things that are showing that this is being held as an investment property. Because if you are audited, and it does happen, but not very often, and as long as you have your documentation in place, it's not anything to be worried about. The IRS will just look at your intent at the time of the exchange. And so a shorter timeline could still qualify if it was truly held for investment and not resale. So any questions on that?
No, I don't have any.
Okay, great. So here are some common mistakes I want to make sure that we kind of go through. Uh, don't close before calling a qualified intermediary. This happens pretty often. People will call and go, "Hey, I just closed. I want to do a 1031." It's like, oh, you're going to have to do it on your next property because you've taken control of these funds and you have disqualified yourself. and the money went to a personal bank account at closing. Unfortunately, any funds that hit your personal bank account is considered boot at that point, which is taxable. A lot of people will miss these deadlines. You can get an extension on your tax return, for additional time. You can't on a 1031. There's a 45-day and 180-day deadline, and they mean it. So you have 45 days to identify and then 180 days to close. Um, the debt piece is also very important. If you had a $100,000 mortgage, again, you just need to make sure you take out at least that amount, either in one property or between several properties. Or if you do a syndication, the syndication can also allocate you debt to just make sure that you replace that. Your qualified intermediary will make sure that you address that. Um, some people buy the wrong kind of property. I had somebody that was so excited to sell and then buy this beach house that they were going to use. I was like, oh, you can't do that. It can't be a second home, or it can't be your primary home. It has to be for investment purposes. And then vacation homes that we talked about, um, they can qualify if they are treated as a short-term rental that meets material participation, and that's like a whole nother seminar we can talk about. And you cannot use it for more than 14 personal days. Now, maintenance days,
It's
work days,
only 14 personal days, huh? I didn't know it was.
yeah. Well, but personal days may not be, you may be able to be at the property more than 14 days, but you'll have to have documented that it's for work. You are painting the property, you are checking on, make sure all your silverware is still there, and all the inventory checks that people do. Or, there can be, it makes it a lot more complicated. So generally we discourage people from going toward a vacation home with their 1031 proceeds. Um, but one of the things that is kind of interesting is people will identify a property that they want to buy in their 1031, but they haven't closed on the sale of their original property yet. So if you're on Jim's website and you see a quadplex that you've got to have, you actually can do that. And let me go through what you can do on that as well. Again, you will, oh, I guess it's not on this slide, but essentially what you're going to do is work with your qualified intermediary. They will purchase the property on your behalf and then roll it into the 1031 exchange upon the sale of your primary property. So I've got a screen on that here in a second. So these are just a few FAQs that we get about 1031s. I thought we'd go over. Um, Partial 1031s. Some people say, I've got this $1 million. I would like to be able to take out $100,000 or X dollars to do whatever with. And that's fine. You can take out that. Just know that any amount of it that you do take out will be taxed. It doesn't have to be all or nothing, but any part that you do take out will be taxable. And like we talked about, you can 1031 into multiple properties or sell multiple properties. You can sell one property and buy several, or sell several and buy one, as long as you just make sure all the timing works. Again, I've gotten into a lot of detail on this vacation home and personal use restrictions because I see it all the time. Just make sure if you are working with either one of these that you have it documented properly. Um, we also talked a little bit about 1031ing into a syndication to do some type of diversification. And what you would do is not just invest in the limited partner units. Like if you look into these, you'll see them all over the internet now, where you would buy limited partners shares. Um, that's not considered like kind because you're not investing in actual property with a limited partner unit into an LLC, for example. So those have to be structured properly as a tenancy in common. So you're actually in the real estate and not in the investment units. Again, it's something that if you work with a sponsor of a syndication that is very sophisticated in this, they can walk you through it. It's not a big deal, and your qualified intermediary can as well. But just know that you'll hear sometimes, oh, I can't invest into a syndication because it's not like kind. And that's true. It just has to be structured properly. Disqualified parties. Again, you can't use your attorney, your CPA, or anyone that you've worked with in the last few years as your qualified intermediary. So that's very important. And again, we talked about what happens if you die when you have a 1031 property. And that's literally, like we joke, it's the most powerful estate planning tool, is because you've essentially swapped till you dropped. And so your heirs will get everything at that appreciated value. So if they wouldn't sold it the next day, they would have a zero gain. So that's essentially the whole goal of this. One last thing is, you can't refinance right before you do a 1031 to take money out and then exchange it. That's one of the things that we also see. They'll consider that boot or taxable income. So you can do a post-exchange cash out refi or take it on a mortgage. There's other things that you can do to get cash out, but just make sure you don't do it right before you sell.
So
So
what is there a time thing on that? Is it a year if you're going to refinance?
well, they say if you're going to refinance it before, it would probably be about a year
Okay.
to have done that. Um, but again, all of it has to do with intent. So if you happen to refinance a few years ago, or a year ago, or just under a year ago, and then found this property, as long as you have it documented again properly, it will probably be just fine. But if you list your home and to sell, and then you go and take out a new loan to get cash, that's where it doesn't work out. So again, it's just making sure you have it documented properly.
Got it.
So one thing that as a CPA I love is depreciation and accelerated depreciation and cost segregation. I'm not going to go into a lot of detail on this, so if you're watching this, you can just read through all of this. But essentially, what you're going to do in a 1031 exchange is you're bringing over your existing basis with you. So from our example before, we ended up with a basis of $197,000. When you do bring that over, your new basis is going to remain at $197,000, not the $1,000,000. So you can't go and take this accelerated depreciation on that. However, if you did buy extra properties, invested extra debt or equity, you would be able to depreciate that. And again, maybe we'll just have another talk about cost segregation, because even at these small amounts, and especially if this bonus depreciation comes back, or 100% bonus comes back, there are some amazing things that you can do to actually offset all of your passive income. So all of this monthly income that you're getting in, you would be able to offset it where you're literally paying zero taxes on that income. So very, very strong
Yeah.
tax strategy to be able to do that.
Yeah, that is huge right there.
Yeah, and you don't have to cost set your entire portfolio. Generally, you can just do one property or two properties, and that will give you enough depreciation to be able to offset all of your income for that period. And then anything you don't use, you can roll forward into the next period to offset. So very, very good stuff. So, and again, I just wanted to reiterate, if you don't replace the debt, it will be taxable. So just reinvest it all, follow the rules on here, and you should be good. Oh, here's the slide about where I talked about the reverse exchange. If you do find something that you want to buy before you've sold your current property, again, make sure that you just get in touch with your qualified intermediary. They will put together a special holding entity for you, and it will still qualify for the full 1031 deferral. So, but again, just make sure that you call your QI first and get it set up beforehand.
Very good.
So, um, like we mentioned here, I've worked with plenty of really great qualified intermediaries. That's such an important part of making sure that you've got your 1031 right. They will help educate you on the process and make sure that when you do find that property or you do want to go under contract, that they've got all of the pieces in place for you. So feel free to just reach out to me. You can see my email address right here. It's Michelle at collegiate-capital.com, and I'll be glad to connect you with some great ones. So
I think overall 1031s do not have to be the mystery that we've made them out to be. Again, there's a few basic
Right, right.
rules, having a good intermediary, understanding exactly what it works. It's not a single family home sold to a single family home bought. You have lots of options. And obviously you want to talk to a tax professional, which you are.
Yes.
How can people learn more about, what you do and how you help people with?
Absolutely. I'm very active on LinkedIn, so feel free to connect with me there. There's a lot of good content. And then also my email address is Michelle, as spelled right here, at collegiate-capital.com.
Excellent, excellent. Well, that was very complete. I think we answered the questions along the way. I think for people to ask themselves, is it worth it? I think in a lot of cases it can be worth it. So don't let the details confuse you. I mean, watch this once, watch this twice, get in touch with Michelle, talk to one of our property counselors who's done these before. But with a little more effort, when you start to look at the compounding effect of your wealth growing tax deferred compared to paying taxes along the way, or even for that generational wealth, the step up basis, I'm hoping to see my children have that on properties that I want to leave. So very powerful technique here, Michelle. I appreciate you being on. And we'll look forward to our next call on cost segregation.
Absolutely. Thanks so much, Jim. It was great talking with you.
You too. Thank